Welcome back to the Property Frontline. Today I'm here again with Jane Purnell from Holzworth Partners. Hi, Jane. So Jane is a financial planner, accountant, and finance guru. And today we're going to be talking about buying property through your SMSF. So there's a lot of people who are really looking at this as a really great way to get control of the funds in their super, because more control should equal better results and more cost-effective returns, because some people are suspicious about where their money goes. So why don't we just kick off with my first question, which is, what should people understand for deciding to buy with their super?
So, look, the most important thing is your super fund's there for your retirement benefit. So every decision you make must tie back to your retirement plans. And that's really, really important thing because, like you said, it's about control. People want to have control, but the goal's got to be that retirement plan. Other things that you need to consider before buying in a self-managed super fund's not the same as buying it personally. It's going to be slower, more regulated. It's going to possibly be more expensive up front, and needs to be justified strategically. So it's not just a let's get this done. I've seen a great deal and I want it now kind of process. You also need to have the right members in your fund. You can have up to 6 members, but you want to make sure that the goals are all aligned in that self-managed super fund. And things that you really should know earlier, liquidity matters. So the property is going to tie up a large portion of your super fund. If you're planning to retire in 5 years, how are you going to pay for that retirement? Also, you need enough money in there for the insurance, the audits, all of that, your land tax, your rates. Liquidity is a really important aspect. Just because you've got $700,000 in your super fund doesn't mean you're just going to go out and buy a $700,000. No, absolutely not. And diversification, you're tying up. So, the rule of all investing is diversification. If you've only got property, you've got a risk there that you need to consider as well. So they're the things that we usually discuss first up with everybody.
Yeah, okay. And in relation to the amount of money that people have in their super, I normally say, not that I'm allowed to give advice about it, but people will always ask me, I will normally say you really need at least 300,000 in your super before you even think about putting a property in there. Would you say that's still like a good?
100%. Anything, anything around that 200,000-300,000 mark. If you'd go a little bit less if you've got 6 strong members, all with high income and great contribution history. You might go a little bit less, but in general, if you stick to those 300,000 marks, you've got enough there for the deposit of the property. It's about the balance, but it's also about the contributions.
Yeah.
If you got a couple and one's semi-retired and one's not, those contributions aren't going to be enough.
Yeah. So setting up, which is, can be a minefield unless people speak to someone like you. So how does an SMSF need to be structured to buy property, and who should be involved in setting it up?
All right. So there's one major structure that you need, and that's your self-managed super fund. So that is a trust. So we establish a self-managed super fund trust deed, and nearly always we look at what we call a corporate trustee. So there's a company involved there as well. That's the trustee of the super fund. We do that because it's great for asset protection, ease of administration, and if we're going to involve some lenders, they prefer a corporate trustee. First, we've got to have that. Now, if we want to borrow money, we need another structure. And this one, depending on who you speak to, has got a couple of different names. It's an LRBA trust or a holding trust. You might also hear the word bear trust or property trust. All depends on who you're speaking to. But that's designed for the borrowing of the fund. Again, it's a trust, and then we have a company as what we call the corporate trustee. And most lenders require it to have a corporate trustee. That's non-negotiable. But the important part of that trust is it holds the legal title while the self-managed super fund holds the beneficial interest. So it's about making sure we're protecting your assets during that borrowing process. Now, the people involved, and this is why it can be a little bit more expensive up front, you need financial advice. You need to make sure that it's the right thing for you. You understand the risks. You understand the benefits. And it does suit you and your family.
Mm.
Then you're going to need an accountant to do the structure setup, the registration, the compliance, apply for the ABNs and the tax file numbers. You're then going to also need an auditor that will audit it every year. Then we're involving our lawyer. So they're going to do the contract reviews, the lease agreements, the conveyancing. A mortgage broker who's going to go through and do all the lending and find out the right lender for you and what you're purchasing. Then you need your property professionals, your buyer's agents to help you find the property, valuation, building and pest. And last but not least, a property manager to help manage the property for you. So there's a lot of people you're going to be speaking to all in a very small period of time.
Yeah, that's right. And that's why I think it's really to have like just 1 to 2 really key points of contact who can coordinate all the other specialists. Otherwise, it's very difficult to do it by yourself. Actually, it's impossible, isn't it?
Yeah, and look, it's a lot. It's a lot of work to do it by yourself, and you might think you jump online and go, oh, well, this is really cheap. I can do it all online. But one issue or one error in setting up those documents or those trust documents can cost you a lot.
Yeah. Yeah, that's right. So on the finance side, what's different about borrowing through an SMSF and what are lenders currently looking for?
Okay, so like we mentioned before with that trust, the Bear Trust or the limited recourse borrowing arrangement, that is what's going to be borrowing it. And you as the member of the super fund become the guarantor to that. So, and this allows the recourse to stay with the property and not into your personal interests. You'll find that a lot of lenders, when it comes to self-managed super fund, are going to be a little bit more expensive in the interest rates because self-managed super fund is considered a higher risk lending. And not many of your major tier 1 lenders are going to lend to self-managed super funds. It's more your boutique lenders that do self-managed super fund lending.
Mm.
So it's then negotiating all of those terms and working with those people.
Yeah.
So what are they currently looking for? Look, at the moment, it's they're happy with a 70 to 80% LVR or borrowing capacity. So, there's a fair bit of flexibility in there. Cash buffers, they like to see about a 10 to 20% liquidity left in the fund after settlement. They want to make sure you can pay those expenses. Now, your rent and contributions must service the loan. They don't like a case where, and it's a perfect example, a self-employed person that maybe have not been contributing to their super, they're going to look at that and go, well, you've got no contributions historically. How are you servicing the loan? So they like to see those contributions coming in. Like, as I mentioned before, those corporate trustees are just mandated. And yeah, that's pretty much what they're looking for. But varies lender to lender, of course.
So in relation to lenders, you mentioned that it's normally more the boutique lenders, and so they will have a little bit more of a higher interest rate. But recently, Macquarie Bank has announced that they have stopped all lending to trusts but actually, I can't remember whether that would have included SMSFs or not. So, do you have any thoughts on that?
Look, absolutely. With the new anti-money laundering and counter-terrorism rules that are coming in for accountants and banks and being updated, a lot of lenders, um, as I mentioned, there's a lot more work involved. We've got a trusts, we've got two trusts, two companies, mum and dad, and whoever else the members. We've got all of these people involved in any of this thing. Same with the trust. There's a lot of people involved. And the more people involved in a transaction, the more risk that's involved in that transaction. And that's where the banks decide whether or not they're willing to take on that risk. And that's really why they've stepped out of it. It's disappointing because a lot of people set up these structures for long-term goals and retirement planning and wealth
Yeah,
creation and generational wealth. But there's also time and effort in identifying every single person involved.
yeah, yeah. And look, Macquarie might come back in. I mean, the area is so competitive in relation to lending, so who knows what might
Who
happen.
knows?
Um,
Absolutely.
yeah, just got to be really on your toes and make the decisions with the information you've got to hand at the moment. Yeah, okay. And so, in relation to compliance and risks, what types of properties are allowed and what are the most common mistakes that can cause trouble?
So we're allowed an investment residential property. So for investment purposes only. You can't live in it. Family can't live in it. It's got to be purely investment. You can also have a commercial property. Now, the difference with a commercial property, though, is you can have a related party renting it. We refer to that as business real property. So you might be a small business owner and you want to buy the premises that you work out of. You can then do that. Importantly, though, it has to be what we consider commercial. So there has to be a proper lease agreement at commercial rates. What's not allowed, like I said, I've already mentioned, you can't live in the property, your related parties can't live in the property, and you can't use borrowed funds to improve or significantly change the property either. So you can't buy a fixer-upper and then borrow to fix that up. It's pretty much got to be ready to go kind of renting-wise.
Yeah.
Most common mistakes. The biggest one I'm seeing at the moment that causes me a lot of grief is contracts in the wrong name.
Wrong name of the company.
Yeah,
Yeah.
that's it. Because we get excited. The real estate guy sitting there going, "Let's do the contract." Yeah, you stop. Don't let them pressure you. Check with the advisor. What is the actual name to go on that contract? Because there's a lot of drama later on when everybody's signed.
Yeah.
So yeah, definitely stop and breathe on that one. Insignificant liquidity. That can be you won't find it initially, but 12 months down the track when you go do your annual accounts and the rates are due and the audit's due and all of a sudden you don't have enough money and that's in your super fund to pay all of those expenses. And then it can be actually in breach. So making sure there's enough liquidity there at all times. As I mentioned previously, using the borrowed funds incorrectly, doing, kitchen upgrades or improvements to the property. Also with things like I had mentioned with the business real property or a commercial property, not renting it to your company at a commercial rate. So it's really important to make sure that is a commercial rate and has been independently verified. So, it's getting an evaluator in and checking to make sure you're paying the right rent.
Yeah.
And the last one probably that I would consider would be poor documentation. Like I said about, doing the documentation yourself, if it's wrong, there's issues. And often those issues won't turn up until you go and do the audit at the end of the financial year.
Yeah. And I would say, like, from a personal perspective, I would say record keeping. Oh my God. Oh my
Keep
goodness.
everything. Because the
Yeah.
auditor in 5 years' time could turn around and go, oh, I need a copy of that minutes that you wrote 3 years ago, and
Mm.
you've got to have it and you've got to provide it.
So let's talk about one of the other key things that seems to trip people up a lot when considering property in your SMSF is that you can't capitalize on the increased value. So outside of an SMSF, if a property really increases great in capital growth, you can reuse that money, go and buy something else. But you cannot do that in an SMSF, can you?
No, you can't. No, and that can be a deciding factor on which, what option is best to buy a property.
Yeah. Mm. Um, but those people who really want to use an SMSF because they can see all that money there and they really want to have more control over it, is it, and you can say no to this question if you like, but uh, is it possible for people if they've bought and then they've their property has doubled in value, would the scenario be, well, sell it and get the cash, then go and buy two or something like that? Um, is that,
That is a very plausible scenario. I mean, depending on what their goal is and depending on how we set it up, and that's probably where that advice key comes in really early in the piece. If somebody was to come to me and say, I want 3 properties that's going to give me rental income in retirement, then we would look at how, maybe we borrow a larger portion and use less of the cash in the fund so that we've got that ability over the years to borrow to buy multiple properties. Or you might, yeah, like you said, a property might go up massively in value, so you might sell it and purchase another property, or you might sell it and reinvest it somewhere else. It gives you a lot of flexibility, but like I said, the downside is you can't use that equity to purchase again.
yeah, yeah. And so, but if you're trying to decide to do something like that, you've really got to look at all the different scenarios, don't you? So, what will be the capital gains tax implications? And, yeah, just working out from a numbers perspective the pros and cons, would you say?
100%, 100%. Every scenario suits different people in different ways. So, holding it in a super fund, holding it in a family trust, holding it personally, all has its pluses and minuses. It's about sitting down and evaluating that before just jumping in and making a decision because somebody at the barbecue that you spoke to said that they did it and it's the right thing to do.
Yeah, yeah, that's right. Okay, alrighty. And so then strategy and performance. When does buying a property through an SMSF make financial sense, and how does it fit into a long-term retirement plan?
Okay, so it makes financial sense if we've got members that have stable contributions and want long-term capital growth. Property suits 10, 20 years time frame. In your self-managed super fund, it's not somewhere where you're going to be flipping properties. It's a long-term goal. And it's really for those members that want control, like you said earlier. Um, you know, Sometimes we want to be in control, and in Australia we tend to understand property a little bit more. So maybe that's a reason to look at it. Then from a commercial point of view, though, for small business owners, it can be extremely effective for a small business
Yeah,
owner to own their
really?
premises. And it's a great one for like a lot of small businesses. They forget about their retirement plan. This is a way to make sure you're taking advantage of your retirement plan at the same time. Uh,
Mm,
so that's sort of really an important aspect. Look, the key considerations that we sort of need to look at would be the retirement plans. Are we going to be able to make pension payments and liquidity, contributions, rental income? We're constantly monitoring and looking at those things to make sure that, it's still right, because it was right 10 years ago doesn't make it right today. So we need to constantly reevaluate those aspects.
Yeah.
So that's sort of, some of those strategies that we look at and consider. But it's all about the individual.
Yeah. And I think also it really does influence, as we said earlier, the type of property. So what we tend to focus on when we're buying property for people who have an SMSF is usually property that really doesn't need too much maintenance at all and has a really, really strong rental return. So something that might already have dual income, and where you won't be tempted to want to knock it down and turn it into a townhouse block.
Yeah.
So, yeah, I know there might be ways around that, but not for this podcast discussion.
Exactly.
Yeah.
For a straightforward scenario, 100%. You want it, those like a duplex or, those kind of things are amazing. The self-managed super fun. But you want nice house and land packages that are already built.
Already built.
Already built, ready to go, brand new, ready for the renters to move in tomorrow. Is where you want to be looking.
Yeah, and that is such a good point too, Jane, because a lot of people get trapped by people hard selling new property, blocks of units, house and land packages, saying, oh, we can set it up in your SMSF. And that is the worst thing you should do, is go to someone who's actually giving you the property and they say, oh, we'll do all of the work for you. We'll set it all up for you, because you're not getting independent advice. You're just on the travelator with someone just only telling you the one thing, and that's a recipe for disaster.
100%. And you hear like, I had somebody come to me saying that the person he spoke to said you could only have a brand new property in your SMSF. I hear these stories all the time, and it's disappointing, because, like you said, it's about them selling the property.
Yeah.
And this is a tool to add on to that.
Yeah, exactly. Yes, so stay away from those. Okay, alrighty. Well, I think that wraps us up for today. We'll have so much more coming. Thanks, Jane, for your insights, as always. Fantastic. And thanks for watching, everyone. If you want to reach out to Jane, her contact details will be in the description box, and mine will also be there. So don't hesitate. And we are preparing a series along these lines of the aspects you need to consider for lifetime income, utilising property, and good financial planning advice. So if you would like to know when when our next podcast comes out, make sure you subscribe and also give us a like if you get the chance. So that wraps us up. Thank you very much. Bye-bye.